50s. They have grown children. They're business owners. Their net worth was just under 10 million. The profits in the business were 1.5 million on average per year, and their adjusted gross income was 700,000 a year. Their concerns, which are like many of our clients, were A, cutting their tax bill, B, asset protection, C, market risk, and ultimately what they really were searching for was something other than their qualified plan, because they hated the red tape and all the limits that they were dealing with their qualified plan. And also, when they're not here, they want to leave a lasting legacy for their family. So what we did to create the accelerator plan is we actually designed it out so that we could secure $9 million of bank funding, and the loan was made to their business, and it funded 4 privately owned insurance plans that are owned privately, meaning they're not attached to the business. So it's separated from their business. And the point on that is a lot of business owners have all their real wealth inside their business and don't know how to get it out. Well, this is one way you extract that value from the business. And the client, instead of funding their defined benefit plan, instead is going to pay the interest on this loan, which is then tax deductible. So it's creating a tax deduction. And because we're using insurance, it's actually creating a tax-free place to grow money and great tax advantages. So what's the bottom line? Well, for their net payment, they were putting $400,000 a year into and getting the deduction. So $241,000 interest payment, if you will. Inside the policies that they own, the first year they earned $507,000 in interest on $3.5 million that was inside the policies working. There's another $5.2 million that's going to be added over the next 4 years. The reason it's added over the next 4 years is because you can only put the money in so fast, because we want to keep it tax-free. We don't want it taxable. Also, it created $32.2 million of additional life insurance coverage, and they also got the $400,000 tax deduction. So what does this mean? Every dollar of net interest that they paid created $2.10 of interest. It created $14 that is now working for them, and another $21 that's going to be added over the next 4 years. Every dollar created $133.63 of insurance, and every dollar created 39.6 cents of tax deduction. Powerful. We compared this to their qualified plan, and over the next 35 years, it created 530% more actual dollars than their qualified plan on the exact same amount going in. So we wanted to compare how much they'd have to do, or what they'd have to do in the qualified plan to match our program. They would have to earn 17.57% for the next 35 years instead of only earning 6.5% in the insurance program. Or they could choose to invest $873,000 a year versus $400,000, or they could put money in for 30 years instead of 15. So as you can see, the accelerator plan really performed against it. Why does it work? We're using arbitrage. We're using the tax code to our advantage, and we're using leverage. Leverage is created through the bank loan and the insurance. So instead of just putting money into a qualified plan and growing the interest and then ultimately having to pay a bunch of taxes, they are instead using arbitrage